And at this point, guys, I'll just say good morning to everybody that's joined us so far. It is 10:30. We are looking at kicking off on time. So in the scheme of today's things, welcome to everybody that has joined us. And I hope everybody's surviving lockdown at the moment, especially for our wonderful brokers that are joining us from New South Wales and Melbourne this morning. Life has definitely taught us a whole new way of dealing with things, and we're back on webinars at the moment. Today we will be joined by Cameron Garnham from Strive Financial, so it's something a bit different, delving into the world of short-term lending and the things that they're looking for after their side of things. So most of the FBAA members that are online today already are aware of who Cameron is, and they've seen him with us for the better part, I think, now of the last 8 years. So no introduction needed there, but for those of you that are joining us that aren't FBAA members this morning, good morning. And we have quite a large registration number coming in from the Women in Commercial Forum that's from Facebook. So ladies, thank you for joining us this morning as well. Just to give you a brief introduction to Cam, and we've had the pleasure, as I said, of working with him for the past 8 years. Cam's been involved in the short-term lending business for over 14 years now and seen every scenario humanly possible. He's going to be discussing with us this morning the process and benefits of short-term lending, as well as the hidden pitfalls that will allow you to navigate the short-term lending space with absolute confidence. I've got confidence that Cam won't stuff this morning up. Guys, with the current property market filling the Australian SMEs with absolute confidence, many are looking to take advantage of opportunities in their businesses to expand and grow. The incredibly fast, flexible options that short-term lending offers you and your clients can be the difference between getting a deal done or missing out completely on an opportunity. Shortly, I'm going to pass you over to Cam. However, just to let you know, should you want to ask any questions during today's presentation, please ask your questions in the chat box located hopefully on the right-hand side of your screen. What I'll do at the end of today's session is I will run through all of these questions with Cameron, and as long as time prevails, and even if we do go a little bit over, guys, we'll make sure we get to as many questions as we can, and if we can't get to all of them, we will email you independently, and we will let Cameron know what those questions are, and we'll get Cam to answer you directly. So you'll be able to also watch this webinar back and any other educational webinars that the FBAA has already completed on the FBAA YouTube channel. There will be an email following today's presentation as well as the 1 hour CPD code. This is always a mouthful when you need to read this. So guys, I'm going to pass you over to Cameron, or I'm going to ask Cam to join me now, and we'll just wait for his camera to come on. Hey Cam, good morning.
Hello legend, thank you so much for having me.
Oh, that's all right. We're back working from home, Cam, so I'm assuming you're back working in shorts instead of dress pants.
I am, you are very, very correct. I've got my pair of yellow boardies on.
I'm so glad that we're back in board shorts. I'm not going to say I'm sitting here in gym tights with my FBAA shirt, but this is okay. So Cammy, I'm going to hand over to you for this morning's presentation. As we said, guys, any questions, pop them down in the question box, and I'll see you on the flip side.
Thank you so much, mate. Now, I can't promise that this won't be a muck-up. Technology and I don't get on all that well, to be brutally honest. I'm lucky to be able to turn a computer on, never alone try and navigate our way through this. But apparently, it'll be nice and simple, Mariah promises me. So thank you very much, everyone, taking the time this morning to join us. I know life is fairly stressful at the moment for a lot of us, especially people in New South Wales going through what you're going through, and people in Victoria been going through it for almost 18 months, I guess. And we've been fairly lucky up here in Queensland that we've had short, sharp lockdowns, one just ending last week, but touch wood, things have been okay up here. So again, thank you so much for taking a little bit of time out of your day. If you do have questions, please ask, because I only cover stuff that I think you might want to know. If there are other things that you would like to know around the short-term lending, whether it be short-term secured lending or elsewise, please put them in the chat box, or feel free to get in touch. I'm always more than happy to have a chat. As Leah said, I've been lucky enough to be doing this now for going on 14 or 15 years, since about 2006. So most things that are going to be covered in short-term lending, I've come across over that period of time. So today, listen, I want to explain a little bit about how short-term lending works and what a short-term lending deal looks like. So you'll always hear people like myself saying you need to diversify, you need to look at different income streams and what have you as brokers. I guess what I want to try and do today is give you a bit of an insight into what you would be looking for in a short-term loan, so that you know it's going to work for yourself, it's going to work for your client, and it's going to work for the lender. Because at the end of the day, if it works for the lender and it doesn't work for the client, it goes pear-shaped. If it works for the client and doesn't work for the lender, it goes pear-shaped. And that's what we're trying to avoid at all costs in short-term lending, because it can get a little bit messy. We'll get straight into it, guys. So there's 4 questions that we usually get asked in our short-term lending stuff. So number 1, let's go through what the critical information that you need from your clients are, and how this actually works. So when clients come through to us, there's 5 questions that we need to ask to work out whether the client is a short-term lending client or not. The first one is, how long do they need the funds for? It's the first question I ask any client or any broker that rings me with a scenario, because if they need the funds for 2 years or 3 years, then they're very unlikely to be a short-term lending client. We have 3 different products. So we have a product anywhere from a week through to 3 to 6 months. We have a 6-month product, and we have a 3-year or up to 3-year mortgage fund product. So that first question allows me to work out what product a client may fit into. Exactly the same way you'd be looking at your clients. Now, do they need the money for 3 weeks? Okay, we can look at into the short-term stuff. Do they need it for 3 years? Well, we need to look at some sort of mortgage fund style product. So how long they need the funds for is absolutely critical. The second question we ask, so if they tick that box, they're looking for money for 3 months. Great, tick that box. It fits so far. When are the funds needed by? Absolutely critical. There is always an urgency with short-term lending. If people don't need the money for 6 or 8 weeks, the clients will be able to go through a Bluestone or a Pepper or a CBA or somebody else. If they've got time to sort themselves out, typically a client that will fit into short-term lending products will typically fit into longer-term products as well, if they've got the flexibility of the time that they need to get that sorted through one of the major banks. So you'll find with our stuff, there is always an urgency. They might ring on a Wednesday and they need to pay wages by the end of the week on Friday. Okay, there's an urgency around it. So the willingness to look at the cost of short-term lending when they need it for a short period of time and they need the money turned around quickly, that's another tick that this may fit a short-term lending scenario. Next, we always need to know what the funds are going to be used for. So we're only able to do business or investment lending. So it has to be outside the consumer credit code. Now, this is one that does get a little bit tricky for brokers that haven't played a lot in this sort of space. What determines whether it's a business loan or a consumer loan is what the client is doing with the loan funds. So it has nothing to do with what they're using as security. They can be using their personal principal place of residence as security, as long as the money that they're borrowing is going to pay wages, or it's going to business cash flow, or it's going to purchase equipment for their business, or what have you. So it's always where the money is going to. So we had a gentleman ring yesterday. He was looking to borrow some money for a 3-month period to do some minor touch-up work to his farm before he sold it. Now, that property was owned in his personal name. It was a residential property. So because the money was being spent on that residential property in his personal name, although it ticked the short-term boxes that he only needed the money for 3 months while he sold his property and he wanted the funds straight away, because the funds were being used on a residential property, owned in his personal name, it's then caught under the Consumer Credit Code, which then means that we're unable to help. So absolutely critical. Question 3, what will the funds be used for? The majority of our loans are all to companies. We very rarely will lend to ABN holders anymore. If we do lend to ABN holders, they need to be able to provide tax invoices for what they're doing with the money. So we're unable to give a ABN holder a business cash flow loan. They really do need to be able to prove what they're doing with that money. Companies are a little bit different. We still want some information around what they're doing with the money, but if the money's going into their company account, it's a little bit more flexible around that. Question number 4, how will they repay the loan? Absolutely critical. People say to me all the time, Cam, how can you not get financials or tax returns or BAS statements, or we don't even need to get bank statements to see what money is going through their company bank statement on a monthly basis? The reason is because we need to know what the exit strategy is. That's what's important to us, is how is the client going to repay the loan? You'll find with a lot of the new short-term lenders that are the cash flow lenders, they might not take security, but they want to see their security is in the bank statements, in the company's cash flow, and how much money they're making on a daily basis or a weekly basis or a monthly basis, and then they'll lend against that. At the moment, that's obviously really, really difficult. We've been really busy in the last 3 or 4 weeks, especially because a lot of that cash flow lending has virtually not shut down, but it's much harder to get one of those cash flow loans currently because you can't show, when the entirety of Sydney is in lockdown and Melbourne's back in lockdown, it's very hard to show bank statements that have the money going through them that these guys want to lend against. So we're able to lend against security on an exit strategy. How's that money going to be repaid? So we deal with a lot of guys that don't have that consistent cash flow. Builders, for instance, they don't have consistent cash flow on a daily or weekly basis. They might get lump sums every 6 or 8 weeks every time they put in a progress payment to the bank on the house that they're building. So they might get lump sums of $50,000 or $60,000 every 6 weeks or 8 weeks, but there might not be anything going to their account in between those payments. If that's the case, it's going to be very, very difficult to get a cash flow loan where we look at an exit strategy rather than what the client's cash flow is or what their tax returns are or what have you. So absolutely critical. How are they going to pay the loan back? Very rarely are we going to see short-term loans that are successful that say they need the money for 9 months and they're going to pay back out of business cash flow in 9 months' time. We want to see something a lot more rock solid than that, whether you're doing a refinance for the client, whether the client's selling a property, whether they've won a contract and that contract pays 30 days, end of month, whether they're a builder waiting on progress payments, whatever it is, there's 1,000 exit strategies that clients can show us. But we do want that to be something that's fairly solid. And the last question, so if we've ticked that they need the funds for 3 months, we've ticked that they need it by the end of the week, there's an urgency, we've ticked that they need the money to pay wages, it's outside the code, they're going to repay the loan because they've just won a new contract and that's what they need to pay the wages and get the supplies for. The last question we're going to ask is, what security is the client looking at using? So typically, probably 90% of our loans are first or second mortgages against residential properties. So the director will put up their principal place of residence as security, and we'll take a second mortgage behind whoever their bank is, whether it's a CBA or someone like that. Now, we do some first mortgage stuff, second mortgages. We can lend against some PPSR stuff on the PPSR register, whether it be cars or boats or what have you. But 90% of our stuff will be doing a second mortgage on the business owner's principal place of residence, typically. Now, we don't really have LVRs. A lot of people say, oh, Cam, what's your LVR on these loans? We don't really have an LVR because all of those 5 questions will determine what we're happy to lend. So a lot of what we're happy to lend comes down to the exit strategy. How's the client going to repay the loan? So we've got one currently where the client's putting the property on the market. Well, once the property's on the market and it's on realestate.com, the way the property market is at the moment, it's pretty good. It's likely to sell in the first month or 6 weeks that it's on the market. We're going to lend that client a higher amount than a client that says, I'm going to refinance my property in 6 months' time. Because if they're going to refinance their property, they're likely only going to be able to get 80%, especially typically these types of clients are all business owners, so they're not really PAYG mum and dad. So if they're only going to be able to refinance to 80%, we're probably only going to want to lend to 70% or 75% to ensure that there's enough equity for the client to definitely be able to pay our loan out. So we don't really have in any sort of short-term lending, there's not really, LVRs aren't really relevant. It does come down to the information that we can gather in those 5 questions as to, number one, are we going to do the loan? Number two, how much are we going to give them? Is all determined around that stuff. So they're the 5 questions that anybody that's looking at short-term lending needs to be able to ask. Now, if you get to the last question, the client doesn't have security, that doesn't mean that they're not a loan. It just means that they're not a loan for a secured lender like ourselves. They may be a loan for a Prosper or a Business Fuel or someone like that, because they do need short-term money. They do need it quickly. They're going to be able to pay it back over a reasonable period of time, and they may be able to provide bank statements, which will then be what Prosper and Business Fuel and the like are going to look at. So just because one of those questions doesn't fit into the box, it will just allow you to send that client to the right part of short-term lending. As I say, it may not be us, but it may be another short-term lender that's out there. Over to the next slide. The next thing people ask is, how do private lenders turn money around so quickly? This is a question that we get all the time, because there are a lot of lenders out there that promise you the world and deliver very, very little. Why we can genuinely turn money around in 24 hours is because we are a small family-run company. And a lot of you on here would have heard me talk about Casey, my little sister. She, at the end of the day, is the reason that we can turn money around so quickly. We have our own in-house law firm called Strive Law, which allows us to do all our own documents, all our own searches, all our own settlements. We do all our own PEXA settlements. So everything here is actually done in-house. That's why we can legitimately turn money around so quickly. And then the other reason is our process is so streamlined now after doing this for so long. So when we click over to the next slide here, it'll go through a little bit about how we actually look at a loan and how quickly we can make decisions on it. So typically before an application is even submitted, a broker will call me and say, hey Cam, I've got a scenario, can I run it past you? I'm going to ask the broker those 5 questions. Once I've got the answer to those 5 questions, which literally is a 5-minute phone call and the address of the property and how much is owing on it, we can literally do an RP data search, which is the program that we use to make our desktop valuation and make all our decisions on whether we're going to lend money or not. So before you even submit an application, I can virtually have you an answer over the phone in a 5-minute conversation. Our application form is a really simple 2-page application form, which again is just virtually going through those 5 questions that we just went through. Once we've got that 2-page application form, we need a copy of a rates notice and a home loan statement. From there, you'll have a letter of offer within the hour. Once we have that letter of offer back, Casey does all our loan documents in-house, so we don't need to instruct Gaydens or Summer Lawyers or any other lawyers that then put our work in a backlog of work that they've got. Everything's then done in-house, that those mortgage documents are prepared, and clients, listen, they're signing up all different ways now with COVID. It used to be that I would fly and meet with all of the clients individually. That's a little bit harder now, but we do have lawyers in Sydney, Melbourne, Adelaide, Perth. So your client goes in to meet with our lawyer. Our lawyer doesn't give your client any advice. They simply set up a Zoom meeting with me. I get on a Zoom meeting like this. I explain all the documents to the client. Our lawyers are able to witness the documents. And by the time the client's got in the lift and has exited the building, the money's been transferred to them as cash. So that's just a little bit of a breakdown, I guess, of why we can actually turn it around as quickly as we can. The other really important thing is knowing who is a lender and who is just another broker. So one thing that is really important in short-term lending and short-term business lending especially is that a lot of people will portray to be the lender, but they're not actually the lender. They're just in the middle again. All of our stuff is all our own individual money. When we give you a letter of offer, that loan is as good as done unless something comes up from the client in the searches that they've already got a caveat on their property or something goes wrong after that point. Once we give you the letter of offer, we're committing our funds to it. Now, we have a license to raise money from sophisticated investors through ASIC. It's called a wholesale license. So we do raise money from the public, but we don't send you a letter of offer and then send that loan out and then we can't fund it. So we say, oh, sorry, that letter of offer is not worth the paper it's written on because we couldn't get our investors to fund it. That's not how we work. When you get a letter of offer from us, we are committing our own personal in-house funds to that loan, and that loan is 100% approved and done. So again, just one of the things to really look out for. The next one is around lenders offering lowest interest rates and can you beat it? One of the really important things in business lending or short-term lending is that it's very rarely just about the interest rate. People can advertise interest rates at all sorts of different levels, but you have to be really careful around the other fees and charges that are payable. With someone like us, all of our costs are in the interest rate because at the end of the day, we're a lender, we make money out of interest, so we don't need to charge application fees, establishment fees, desktop valuation fees, commitment fees, risk fees. We don't need to charge any of that stuff. One thing I've been going on about this for the 8 or 9 years that I've been with the FBAA now, is be very careful around any sort of short-term lending or business lending where people want money up front. If it's something up front for a registered valuation that needs to be conducted, and it's something that's reasonable, it's $1,000 for a residential valuation, then that's probably okay. But if people want a 2% application fee up front, or an establishment fee or a commitment fee, be very careful, because typically that's the biggest warning sign that the person that you're dealing with is not the lender. If they were the lender makes money out of interest. If I don't lend your client any money, I don't make any money. Your client can't get burnt with us through paying ridiculous upfront fees and charges. We have a loan preparation fee of $3,450, but that is capitalized on top of the loan. So the client doesn't pay that up front, they pay that out at the back end of the loan when they repay the entire loan. So your client doesn't spend 1 cent out of pocket with us. If they don't get any money from us, it does not cost them a single cent. So quite often I'll have brokers ring me and say, Cam, I've got a loan offer at 2% per month. Can you beat that? Our answer is we can't, but you need to look through what those interest costs along with the other costs actually are. So this was one that I received going back a while ago now. And it just shows here in this table the actual costs of the loan. So I had a broker ring me, and it was 1.5% per month, and our rate was 2% per month on this loan. He said, "Can you do 1.5 for me, Cam?" When we looked through the loan offer, we were actually still going to be almost $9,000 cheaper than the offer that the broker had for the same amount of money that the client was borrowing, even with the interest rate being a little bit higher. So it's just there as an example to be really, really careful of. You can see there's a 4.7% establishment fee, $8,800 documentation fee. Now our $3,450 documentation fee is the same whether you borrow $40,000 or you borrow $3.5 million. You borrow $3.5 million and the document fee is still $3,450. At the end of the day, it doesn't cost any more to do documents. You're just writing a different figure in the document, in the loan amount. So a lot of these lenders will charge a 1% document fee. Well, if you borrow $3 million, it's a $30,000 document fee. It just doesn't make any sense to us. But again, it's because typically we're the lender, it's our money, we're going to make money, we're going to make interest out of that $3 million loan. Where a lot of the other ones that you're paying upfront fees or charges typically won't be the lender. So they're not going to make any money out of lending the client money. So they're going to make their money out of the establishment fee or the documentation fee or the valuation fee or what have you. So just something to be really aware of. The next one here is really, really important, and I get asked this all the time, and I make a bit of fun of it when we're at the FBAA and I'm on stage. And as most of you will know, we're a small family-run company based on the Gold Coast. And everyone, the first question they ask me is, "Are you a loan shark from the Gold Coast, and what sort of motorbike do you ride?" And it's sort of the running joke around short-term lending because it can be a really, really grey area. And for the wrong client, short-term lending can be an absolute nightmare, because if a client gets stuck in a short-term loan, then it goes pear-shaped for everybody. And by getting stuck, I mean that if they think they're going to be able to be out in 3 months through business cash flow, and then that cash flow doesn't eventuate, and all of a sudden it's 8 months down the track or 9 months down the track, and they're in a product that's 2% a month or 3% a month, all of a sudden it starts to get hard to keep those payments up. So it can be a nightmare for clients that are in the wrong product. One thing that we pride ourselves on is making sure, going back to those 5 questions that we ask, that we get the answers that we desperately need from those 5 questions to make sure that your client fits into what is going to work in a short-term loan for the client as well as for us. As I say, we get clients come and want $100,000 business cash flow, and they're going to pay the money out in 12 months' time through business cash flow. Those clients we just will not lend to, because at the end of the day, they don't have an exit strategy. If they need 100 grand just for business cash flow now, how are they possibly going to pay 2% a month and pay that loan out in 12 months' time through business cash flow? They're clients that no matter how much equity they've got in their property, we just don't want to be part of, because it ends up being a nightmare for everyone. Why it isn't a rip-off for clients that are proper short-term lending clients is because of the term that they need the money for. Now, we have a 3% a month product for loans under 6 months, and we have a 2% per month product for people that need the money for a minimum of 6 months. Now, if somebody needs money for 1 month and that's going to cost them 3%, it's not a rip-off by any stretch of the imagination. And there are so many times that people need that. It may be someone needs to pay out their tax debt to have their tax portal up to date so that you guys can refinance their home loan to CBA. And CBA won't do the refinance because they've got the outstanding tax debt. Well, if we pay that tax debt out, and let's say it's $100,000 tax debt, let's say it's going to cost them $105,000 or $106,000 with the loan prep fee and the month's interest to have the money for the 1 month to get it done, that's a really small price to pay to be able to have your home loan refinanced because your tax debt's been paid up to date. So when you work out interest rate and you work it out over a 12-month period and you say, Cam, you're charging 3% a month, and over 12 months, that's 36% per annum. How can you say that that's not a rip-off? Simply because we don't do 12-month loans. If the client needs the money for 12 months, then they wouldn't be a short-term lending loan. And again, I take you back to those 5 questions that we ask at the start. That is going to be our best way for you guys and for us as lenders to work out whether this client is going to be benefited by a short-term loan or whether they're going to be hindered by a short-term loan. Because there are a lot of people that get short-term lending that it actually makes their situation worse. And quite often I say to brokers, listen, we're not going to have this person jump out of the frying pan into the fire, because it doesn't make sense. We quite often have brokers call us that want us to refinance other short-term lenders. And our answer to that 99.9% of the time is no, because they went into this short-term loan with a plan of how to get out of it. That obviously hasn't happened, and now they want to refinance into a short-term loan with us. And that usually is a recipe for disaster. So it is absolutely critical that the right type of scenario works in short-term lending. And that's why it's not an absolute rip-off short-term lending, because for the right client, it is actually really, really cheap. And we've got some scenarios that we'll talk through here in a second, which will explain a little bit about why it's the case. And this one was actually only just the other day, literally 2 weeks ago. We had a phone call from one of our FBAA brokers at lunchtime on Friday, or about 10:30 on Friday morning. And she had a client in Sydney in the middle of lockdown that needed to be able to settle on a super fund purchase at Logan here in Queensland on Monday afternoon at 2 o'clock. Now, the client had paid a $60,000 deposit, or a $59,000 deposit. It was a $590,000 purchase. They'd paid a $59,000 deposit, and they stood to lose that at 2 o'clock on Monday afternoon if they weren't able to settle. Now, after some freaking out, and they're in Sydney, how are we possibly going to do this? They were able to get all the documents through to us Friday afternoon. We were able to have the loan documents to their lawyer, who they were lucky enough to be able to get an appointment with on Sunday morning. They met with their lawyer Sunday morning. We did a Zoom call with them while they were with their lawyer on Sunday morning, had all the documents signed and dropped to one of our agents in Sydney, which allowed us to then be able to settle that loan for them on Monday lunchtime or Monday afternoon. And that saved them the $59,000 deposit that was at risk. They'd also bought it off the plan, and not sure about you guys, but property market seems to be absolutely incredibly good in Southeast Queensland currently. And they felt that the property was probably worth somewhere between $640 and $650 already. So not only did they stand to lose the $59,000 deposit that they'd paid, but also the $50,000 or $60,000 of upside that the property was already worth. So they stood to lose about $120,000. Now, doing that loan cost them $10,000 on a $350,000 short-term loan, and they can have that loan literally paid out within 1 week. So if they have the money for 1 week, and the broker had the loan in with a super fund lender, it was just that they'd been under the pump and they weren't able to have the loan ready and the documents done within the time frame to turn the loan around by that Monday. So that will refinance out. We've already provided all the documentation to the broker and the incoming lender. And that will refinance out. It's going to cost them somewhere in the vicinity of $10,000. If it runs for an extra week, it'll be another $3,500. But even if it runs for a couple of extra weeks, even if it costs them $20,000, if they're going to save $120,000, it's still a really, really cheap option for the client even though the money's costing 1% per week. And as I say, people will say, Cam, that's 52% per annum. It's got to be a rip-off. The client has it 3 weeks. It costs them 3%. It's a hell of a lot cheaper than losing their $59,000 deposit and the property that they were going to purchase. Moving along here, another one we had was an Amazon retailer. And this one was really interesting because COVID had shut down the Amazon warehouse in America. So this gentleman had wigs made in China, shipped directly to Amazon, and then he would sell them on Amazon. Amazon would charge him a fee for packing and shipping. It was about $6.60, but that came out of the wig price. So whatever wigs he sold in a 14-day period, they packed and shipped, and they would pay him 14 days after they were shipped, and they would take their margin out because they were collecting the payment from the client. When they shut down and he had to move all of his wigs to another distributor, that distributor was not going to let him sell 100,000 wigs and be out of pocket $600,000 for the shipping costs. So he had to then pay his shipping costs up front, and then Amazon would pay him 14 days later. So he had a 14-day lag between the item having to be shipped because it was sold off Amazon and Amazon paying him the money, but the shipping company needed the money up front. So we were able to do a $250,000 line of credit for him. Again, it was at 1% per week because he could draw down and pay back whenever he needed to. So if he had the money for 2 weeks, it was going to cost him 2%. Now, on that $6 shipping cost, 2% means that his shipping cost went from $6 to $6.12. Now, no one on this call would not make that deal if they were a business person. For his shipping cost to go up by 12 cents made very little difference to his business whatsoever. However, not being able to ship his product would have made a massive difference to his business. So again, for the right client and the right purpose with the right exit strategy, short-term lending can be really, really beneficial for all clients that we deal with. So what else should you be careful of? Listen, we've gone through most of the things that I talk to people about. Dealing with someone that's got a reputation that you know a little bit about is really important. One thing we see a lot in the short-term industry is companies coming and going, and they might be around for 6 to 12 months, and then they start up under another name again, and another name again, and another name again. Typically, those guys are going to be guys that are taking upfront fees and charges from you. Most of short-term lending, you can avoid the pitfalls of it by not paying anything upfront. The way they get you is they're going to give you a letter of offer straight away, and they give every single client a letter of offer, and then they want an $880 desktop valuation fee. And I had one of these the other day where the broker had paid the $880 desktop valuation fee. So she had sent the application to the lender, the so-called lender. The lender had produced a letter of offer. With the letter of offer, you had to sign it and pay an $880 desktop valuation fee. Once that was paid, the broker got an email back saying, unfortunately, the valuation has come in at less than what the client said, and the loan's been declined. That so-called lender makes $880 every letter of offer that he sends on a desktop valuation fee. But again, if you don't pay anyone upfront, you can't get stung in those predicaments. The other thing that I would suggest that we've already spoken about is a lot of borrowers will only ever look at interest rates because that's all they've ever been brought up to do. And you guys know that in your home loan stuff, someone wants 2.14 versus 2.09 or what have you. In short-term lending, it's not the case. A lot of people will try and suck the client in with a headline interest rate. It might be 1% a month, but that 1% a month then has a 5, 6, 7% of fees in a 3-month period, and then it's 3% a month anyway. They might write the loan for 3 months, and then there's the rollover fee. So if you want to extend your loan, there's a 5% extension fee or what have you. There's quite often astronomical exit fees. When you pay a loan out with us, we charge $250 as an exit fee, and that includes discharging the mortgage, which I think costs $230 odd. So you have to be the protector of your client to some degree when it comes to this space, in understanding exactly what the costs of this loan are going to be, from document fees to application fees to establishment fees, to exit fees, to monthly fees, to rollover fees, and really try and give your client a really clear picture of this product versus that product, so that at least they know what they're up for. The other thing that helps is that the client can make their own decision. So I've spoken to a lot of brokers in my years that just say, Cam, how could I ever put a client into a loan at 1% per week? At the end of the day, it's only ever an offering to your client. So if the offering is, listen, I can get this done, I can have it done in the 2 days, it's going to cost X, Y, and Z. Now the client will then make the decision on whether it is viable for the situation that they're in or not. Because if they're taking advantage of an opportunity or they're trying to fix a problem, it's what that opportunity is worth to them or what fixing that problem is worth to them. Now, as I said, with the clients buying the property in their super fund the other day, the problem was I'm going to lose $120,000. If the solution is it's going to cost you $20,000 to fix that problem, then the client makes the decision whether that's a deal for them or not a deal for them. And the one thing that you'll find in business lending is that you're dealing with men and women that deal with their own businesses every day of the week. And just quickly, I'm running out of time, but I had a great client one time in Sydney who used to be a barrister, and he went from being a barrister into buying pubs, and we did a lot of lending with this client. And I'll never forget, he said to me one time, he said, I used to fight against people like you in court all the time when I was a barrister, and I thought you guys were the scum of the earth, taking advantage of people left, right, and center. And he said, it wasn't until I went into my own business and I owned these pubs that I realized how important to a business cash flow was, and that I wouldn't always have the cash flow that I needed. And if I needed to buy stock, there was no point me having a pub with no beer in it. So if I needed to buy stock and I needed that money quickly and I was going to be able to have it back in 2 or 3 weeks, if my stock bill went up by 3% because I borrowed the money from you for 3 weeks, it was a small price to pay if the stock went from costing me $100,000 to $103,000. And it wasn't until he got into business that he actually understood the benefits of what short-term lending can do for businesses. And when you're dealing with these sorts of loans, you're always going to be dealing with people that are in their own business, and they will then make the decision on whether the cost is worth it or whether it's not. Because if they're not under a time issue, if they can wait 6 weeks to do it, then there's no real issue, and they'll say, oh no, I don't really need it that badly, or it's not that important, or it's going to cost too much, and that's fine. At the end of the day, it's just an offering to the client. So they're the main things that I'd love you to take out. I'm flying a little bit blind on this presentation. The first time you're seeing it as I see it, so hopefully I'm going okay here. So a couple of the takeouts, I guess, understanding the full context and the details, the hidden details, I guess, of the loan. The funding is underpinned by a strong process, and one thing that I will hang our hat on, and I'll argue against anyone, is that our process since 2002, I've been there since 2006, there is not another lender in the country that has the process and structure that we have. And that's simply down to Casey. As I say, I know I can take the mickey out of Casey a little bit, but it's simply down to Casey and us having our own in-house law firm. Because if you can't do your own documents, if you can't do your own PEXA settlements, if you can't do your own lodgements, there's no way in the world that you can turn money around in a 24-hour period. The other thing that you get when you deal with us is that you get someone that owns the business. The reason that we're happy to do a Zoom call with a lawyer on a Sunday morning at 10 o'clock for clients to sign documents so the loan can settle on Monday is because it's our business. If a client rings me at 9:30 at night, if I'm still up, I'm usually in bed, but if I'm still up, that phone call will be answered. If they call me Sunday morning while I'm at the pool with my son, that phone call will be answered because it's our business and that's our process that we run. Always look beyond the headline interest rate, really, really important. And the cost of doing business or not doing business at all, and that's the decision that your client will make. Your client will decide whether it's too expensive or whether the problem that they're fixing or the opportunity that they're taking advantage of is worth doing. So they're the couple of takeouts. With brokerage, obviously a really, really important question. Brokerage is capitalized on top of the client's loan. So brokers can charge as much or as little as they like as a brokerage. It is disclosed, it is in our letter of offer. We are very upfront and transparent with our clients on everything that we do. But you guys can charge as much or as little as you like. Now, when we fund the loan to the client, when they get their 100,000, you get your brokerage into your account the same day. So typically within 24 to 48 hours of filling in the application form, depending on how quick the clients are to get everything done, you'll have your brokerage in your account as cash as well. There's definitely no clawbacks or anything like that. Now, as I say, I've been here since 2006. I've never ever seen a loan fall over because of brokerage. At the end of the day, if you've fixed the problem for the client will calculate your brokerage into the cost of doing the loan, and they will work out whether the loan is worthwhile doing or not worthwhile doing. People ask me all the time, Cam, how much should I charge? And there really is no right or wrong answer. We have some brokers that will bring us clients that they've had for 15 years, and they'll say, Cam, I only want $500 because I've done 15 years worth of work for this guy, and he'll come back and we'll do more and more business over and over again. We have other brokers that just charge a flat fee. It's 1.1% of the loan amount or 2.2% of the loan amount, and it doesn't matter how much the loan amount is or how much it isn't, and that's fine. We have other brokers that find their loans virtually through sort of website stuff, and they've probably never met the client, and they're probably not going to do business in the future with the client. They're going to do this one transaction and that's it, and they might have a flat fee of $4,995. It really is completely up to you guys and your relationship typically with the client, which will determine what you're happy to charge as a brokerage. As I say, we don't set them, and we'll never say, oh, you can't charge that much or what have you. It's entirely up to you with your client. So Leah, that probably wraps me up here. I guess this one's just a copy of our application form. So when I say it's a 3-page application form, I'm not lying. We don't want 27 pages. We literally want their business name and ABN number. We need their names and phone numbers and email addresses, the amount that they want to borrow, the security that they're putting up, and the last page there is just a declaration of purpose to say that it's a business loan. So literally it takes less than 5 minutes to fill in the 2 pages on the application form, and you typically wouldn't even be doing that until you've given me a bell, run me through the scenario, and I've said, yep, let's do it, flick me through the app form. So we try and keep our process as simple and as streamlined as we possibly can, which really allows us to turn the money around as quickly as we promise to be able to turn the money around. And I don't want to waste your time. Even if it takes 5 minutes to fill in this application form, it's 5 minutes that you've wasted if you send it through and I look it up and say, oh, listen, this just isn't something that we can do. Where a 30-second phone call to me to run me through a scenario, and I'll say, yep, we can help with that, send through the app form, or no, unfortunately, we can't help with that one due to X, Y, Z. Leah, I reckon that's about all I've got, legend.
Mate, I think you've definitely got more than that, Cam, but that's okay. I've got some wonderful questions for you, quite a lot of questions for you this morning. I'm going to ask the first question. It's from Raymond Dew, and it is, if you take a second mortgage, do you need consent from the first mortgagee?
Great question. So A lot of people, when they want to take do a short-term loan, they want their second mortgage lodged. So they say they can turn the money around in 24 hours, but then they want the mortgage lodged, which in New South Wales and Victoria especially, you have to get the title produced by the bank. Now that can take 4 to 6 weeks to get the title produced from the bank to lodge your second mortgage. So it's impossible for them to turn the money around in 24 hours if that's the case. With us, we lodge a caveat, which allows us to lend your client the money straight away. We do have the mortgage lodge. We do write to the bank and ask them to produce the title. Listen, every now and then they will say no. In New South Wales, I think they can not consent, but they've still got to produce the title, I believe. So we have very, very few problems with that, but 99.99% of them go through fine. One of the things that we require when we do a loan is that the client's home loan is up to date. Now, we're happy to pay that out of our loan funds. Quite often people will be a month behind or what have you. But one of the reasons we do that is if someone's borrowing 100,000 and they're 3,000 behind on their home loan, we pay 3,000 directly to the home loan and 97,000 to the client. Because when we do write to the bank the following week asking them to produce the title, sometimes one of the reasons they won't consent is that the loan's not up to date. So we always make sure that the loan's been brought up to date. But no, great question. We do lend against the caveat, which allows us to do it in that 24-hour period. But we do then proceed to have our second mortgage lodge, which, as I say, sometimes the loans are paid out before it even happens because it can take sort of 4 to 6 weeks.
Perfect. Raymond would also like to know what sort of rates are they looking for a short-term loan of 1 year, and add to it, are there any associated costs to the loan offer?
Yep, so would depend, it fit into one of our two products. So we have, if it was a first mortgage with a registered valuation, we have a 9.99% product with a $3,450 loan preparation fee capitalised on top of the loan and a $250 release fee. If it was a second mortgage, it would fit into our 2% per month product, which has a minimum term of 6 months, but you can pay out at any stage after 6 months. And that also has a $3,450 loan preparation fee capitalised on top of the loan and a $250 release fee when you pay the loan out. No other fees or charges or anything on top of that.
Perfect. Clint Buchanan would like to say to you, Cameron, it's a really good point that you made, with plenty of brokers out there saying that they are in fact the lender.
Yeah, it's something just to be a little bit aware about. Now, listen, I don't have any real problem with it, right? If someone was out there and they've got some rich individuals behind them and they sort of broker between the client and those individuals, that's fine. Just be a little bit careful about how they're making their money, because typically in that scenario is when you're going to get charged the upfront fees, because that guy's going to do work on the loan and he wants to be paid for it, where we're going to do work on the loan and lend the money and make the money out of the interest component that the client pays. So just be a little bit aware about if they are the lender or whether they're representing the lender, for instance. Listen, there's probably still some people out there that do that okay. The fees that they charge might not be that bad, but I'd just be really aware of it. It's just something that you can get stuck in, and then it leaves a bad taste in everybody's mouth. The client's lost $1,500 establishment fee or whatever, and they're going to blame you, the broker, and then you've been left with a bad taste in your mouth with the lender, and it gets really, really messy.
So Paul Boyd Skinner would like to know, does this all mean that the borrowers don't need independent legal advice?
Yeah, that's right. So how that works with us, if it's under 200,000, the client doesn't need independent legal advice. If the loan amount is over 200,000, then they do need to receive independent legal advice. Now that's getting played with a little bit with COVID. So we signed a loan up yesterday in Sydney, and the client was unable to go and see our lawyer. So if they're unable to go and see our lawyer, we do a Zoom sign up. We email them the documents, they print the documents. I do a Zoom call like this where I explain the documents to them and have them sign them correctly to make sure they don't miss anywhere. In that case, we do require them to have independent legal advice if they're not going to be meeting face to face with our lawyer. it's virtually just another safeguard for us. As I say, we're a little bit funny like this. As scared of borrowers are of us being the big bad loan shark, we're 10 times more scared of the borrower, right? Because we're giving someone $750,000 that we've got a 3-page application form off and have spoken to on the phone a couple of times, and 24 hours later, we could be giving them $3 million into their account, which is one reason why we've always gone to meet with our clients face to face. I would fly to Perth, I would fly to Sydney, I would fly to Melbourne, so that I actually got to sit with them, make sure their ID wasn't fraudulent, make sure they hadn't brought their girlfriend as their wife to sign the mortgage documents. And don't laugh, that's happened twice to us over the 15-year period. But we haven't been stung by it because we actually go that extra distance to make sure that everything here is legit and above board. So because I'm unable to do that with COVID now, we sort of have our 5 lawyers around the country that the lawyer sort of does that for us. If they're unable to go there because of the lockdowns and they can't leave their local government areas, as it is in Sydney at the moment, then yes, we do require them to have legal advice, because it just gives us another layer of protection in between.
Okay, so this one, if I say your name wrong, I do apologise up front. I think it's Dharamir Nagpal. Your question to Cameron was, does the borrowing company have to be trading, or can it be a non-trading company as a borrower?
No, so it doesn't have to be trading, because again, we wouldn't even know. We don't ask for financials or tax returns or what have you. It can be a one-day PTY Ltd company. It can be a company that was started yesterday. There's no problems with that at all. It does need to have a bank account, because the loan funds do need to be deposited into ABC PTY Ltd's bank account. So it does need to have a bank account that we can transfer the loan funds into and take the direct debit, the monthly or weekly payments out of. But no, we wouldn't know if it was trading or not.
Perfect. And Jahangir Islam would like to know, how does he get accredited with Strive Financial?
Yeah, listen, we don't have any accreditation process here, especially for our friends at the FBAA brokers. So literally, it's as easy as grabbing my phone number and giving me a bell, having a chat through a scenario. I'll send you an application form. We can pay you a brokerage via we just require a tax invoice made out to the client, but we pay it on the client's behalf when we fund the loan amount.
And I still think it is good to caveat that part though, Cam, if people are with an aggregator and they're operating underneath an aggregator's credit license, although it's non-coded what you do, it is always best to speak to your aggregator and let them know what you're doing.
Always best to check. And listen, we're on a pilot program with Vow Financial at the moment as well, one of the aggregators. So listen, we're not somebody that an aggregator is going to say, oh, you can't touch them with a 10-foot pole. As I say, we've been with Leah and Pete, luckily enough, for the last 7 or 8 years. That relationship wouldn't be possible if we were a company that was doing the wrong things or taking advantage of people or what have you. So we're very grateful for that relationship.
Perfect. Oh, look, Cam, I thought the bond there was because Pete also rides a motorcycle and he could qualify as the dirty bikey loan shark from the Gold Coast. But I didn't say that because Pete's not on this call today and performance reviews have already been done.
I can't even ride a motorbike, mate. So Pete's worse than I am.
Well, and look, I don't know if it's worse than what you are, if he's a step ahead of where you are as well, Cam. But Pete's not on today's call, so look, it's always safe after performance reviews that I say something like that. Yeah. So Michael Green would like to highlight the fact that you actually brought up a valid point that cost is not relevant. It is really about the commercial decision. And Cam, I know throughout the PD days, you've been doing an exceptional presentation in regards to that as well, about it being a commercial decision. So I think that really does highlight the fact that this is about getting the person into a better position today, rather than making them wait excessive times to get mainstream lending through.
Yeah, it's absolutely critical, and I know I've covered off a little bit, but and the really simple example, and when I break it down as simply as I can, and I use a can of Coke or a bottle of water for a shop assistant, right? If you don't have a can of Coke in your fridge as that cafe to sell, if the can of Coke costs you $1 to buy and you're going to sell it for $2, if you don't have that can of Coke in your fridge to sell, you can't make that dollar. Now, if you borrow that dollar from us to pay the supplier so you can put the can of Coke in your fridge and sell it, if it takes 3 weeks to sell it, that can of Coke's now cost you $1.03 because you've paid 3 cents in interest, being 3%. I can't make it any simpler than that. So you make 97 cents out of the transaction instead of $1, but you can't make that dollar if you don't have the can of Coke in the first place to put in the fridge. And that's as simple as it is for most businessmen and women that are making a decision around short-term lending. And one really big opportunity that's out there at the moment, I was saying that the sort of the cash flow lenders are struggling a little bit at the moment because they can't approve loans because there's no cash flow going through businesses. We're actually right on the flip side of that, because at the end of the day, what we're going to lend you is going to be determined around those 5 questions. But one of the real big things is what your property's worth, what your security's worth. Now, we've seen one of the biggest property booms in every state in Australia in the last 12 months that we've probably ever seen in the history of Australia. Some properties prices are up 30, 40, 50%. So a lot of people at the moment have great confidence in what they're doing, because the property market is so strong, and they're releasing equity within that property. They might have $400,000, $500,000, $600,000 extra equity in their property than what they had this time last year. And that allows them to take advantage of those opportunities that they then see in their business. So where some of the business lending is falling away drastically because of these lockdowns, ours is sort of going the exact opposite way because the property prices are so strong.
Perfect. And the final, well, there's 2 more questions. One's been sent through from Gary Techney. How is brokerage paid to the broker?
So we require a tax invoice from yourself, but it's paid directly to you. Listen, if your aggregator wants it to go through your aggregator, that can happen. But typically, it's paid directly into, you have your bank account details on the tax invoice that you provide me, and it's paid directly into your bank account.
Perfect. And we've actually just had a couple more questions get shot through, Kev. So I'll quickly run through these ones. Would you lend against land for, sorry, this is from David Weaver. Would you lend against land for investment construction loans, company ownership, exit strategy with the sale being on completion?
Yeah, most definitely we can. So the really important part there was that it's a company ownership. So if Jane Smith owns a block of land and is going to build a house to sell it, we can't do that, because even though it's an investment property, any loan now that is a residential property owned in a personal name is classed as a coded loan. But if a company owns it, yeah, we can most definitely do that. Now, we don't do construction funding as such, where we are able to do progress payments and drawdown payments and what have you, but we do typically top builders up. So a lot of the time we'll have someone come to us where they've got to lock up stage, and the builder needs 150 grand to finish it. He's done it with his own cash flow so far, and he needs 150 grand to finish it and get it sold. And we'll come in at that point where he's run out of his own money on the half-built house. We give him the 150, he finishes it off, and it's out the door 3 months later when he's got it sold. So most definitely we can look at that sort of stuff.
Perfect. Cam, I've got a question for you that's been sent through to my phone. I've got a broker just questioning if they've not been experienced with short-term lending before, or they've had no experience with short-term lending, they've got a transaction that's come across their desk. Are you guys able to step in and help them through that? Obviously, they're not going to have the same amount in brokerage as somebody who's experienced short-term lending, but can you guys step in and guide them through it step by step?
Most definitely. And listen, we do it all the time, right? And this is where we virtually leave it up to the broker. We're happy for the broker to be as involved or as removed from the process as they like. And that doesn't ever change the brokerage that the broker wants to charge either. So we have some times where the broker will literally ring and give me a name and a phone number and say, this gentleman's looking for X, Y, and Z. And I ring him and I'll send the app form directly to him, and and away we go. We have other brokers that come to the sign up. So the app form goes to the broker, the letter of offer goes to the broker. Everything goes through the broker, even to the point where the broker will come and sit in on sign up to make sure that I'm doing my job properly and that their client's comfortable, and he can answer any questions that the client's got. So most definitely we can do it either end of the extremity or somewhere in the middle as well, most definitely.
Perfect. Siva has asked if we can send through a copy of your draft application form and the presentation. And I've noted Mariah has put a note up for everybody to say this presentation will be available on the FBAA's YouTube channel shortly. Cam's nodding his head on the application form side of things. So we will get that through to all attendees on today's webinar.
Yeah, awesome.
So we'll make sure that happens. Perfect, guys. And Clint Buchanan also says the biggest upfront fee that he's ever heard of on short-term lending is $183,000, and the borrower actually paid it. So yeah, that's mortified me, Clint. Thanks for that. You've highlighted my my day today.
I'd love to know if they got any money after they paid it.
Yeah, look, that's a holiday in Mallorca. Let's be honest there. And Danny's son would like to know, on construction top at near end of completion, what percentage rate on TDC or GRV would you go up to?
Listen, it really is a case-by-case basis. So on stuff like that, we typically want to see some photos of where the property's at, some information around, depends if they're their owner builder, like if they're a building company and they're building their own, or whether they're an investor that has got a building contract in place with another builder. So it's a little bit hard, that one. We just need to know a little bit more information around that sort of stuff. We don't really have LVRs, if you know what I mean. We virtually, John and I make a decision on what we think it's worth, how much they're looking for. It's going to be low, do you know what I mean? Like, we're not going to lend 80% of the completed value if it's not completed, sort of thing. So yeah, they're sort of on a case-by-case basis. I'm sorry I can't be more sort of direct with that, but
that was on that really, one, that was very,
yeah, all of our stuff really is on a case-by-case basis.
Yeah, and that's perfect. Daxa, look, I can answer you directly on this one. As we said, the video presentation will be available on the FBAA's YouTube channel, and it will be the entire video that we've done today. If anybody else, like Daxa has said, would like to become accredited with Strive Financial, you will receive Cameron's details in an email that will follow today's presentation. So just clarifying that for everybody again, the video presentation will be on the FBAA's YouTube channel shortly. Clint, thank you for following yours up by saying the $183,000 that the client paid, they also didn't get the loan after. We'll talk about that offline. But guys, I do want to thank Cameron for joining us this morning, and all of you for taking the time out of your days. I understand with lockdown, it has been incredibly difficult, and there's been a lot of sort of issues out there with people's mental health and that as well. But hopefully everybody's in the situation now where you are going through webinars like this and reaccrediting yourself, or also becoming familiar with the other types of lending that are available to you out there. Cami, your time is precious, so we won't hold you up too much longer, but just thank you for your time. I'm sure that everybody found it educational. I learned so much from today, and I've also got Mark Windrum, our West Coast manager, online, who's also said that he's learned a lot from today as well. Yeah, we do appreciate, you know, more than anything, a very good understanding and a very thorough presentation on short-term lending, and also some of the pitfalls of it as well that people may not be aware of. So we thank you and the team over at Strive for today's presentation, and for Casey being as diligent as what Casey is as well over there and making sure you boys stay in line. So we do thank you for that. Guys, as I said, we'll be sending through Cameron's contact details on email. Should you need any other information, please email me directly. Most of you have my email address, which is leah@fbaa.com.au. I think I have the easiest one in the company after 11 years. You will get 1 hour CPD from today's educational session. We did go a little bit over, but I think there's been some fantastic questions that have been asked in today's session. So thank you so much, everybody, for joining us. One question that has come through though, Cam, that's not related to Strive Financial: is the conference still going ahead? Yes, guys, it is. It's come through on text. It's happening on the 5th of November, all things COVID going well. So jump on the FBAA's website to also have a look at the details for that. But again, guys, thank you to everybody for your time today. It's been fantastic being able to present this session with Cameron, and we hope to see all of you soon. Bye for now.
Thanks so much, guys.